Yeah, thank you. It's really an interesting juncture for emerging market assets. On the one hand, when you think about the fact that core rates have been moving fast, they have been real rate driven, and they have been policy driven, as in, policy shifts are causing this move in rates rather than, growth or better news on cyclical activity. Those types of shifts are typically quite painful for emerging market assets. But what you've actually seen so far is that, yes, there have been some pockets where there has been, volatility, some depreciation in currencies, but by and large, EM assets have actually withstood this bout of core rate volatility quite well, both on the currency side and on the rate side. Even some of the equities have been doing well. It's really the hard currency credit universe that has taken the biggest blows. And so I think that's what we were trying to get at. But yes, of course, if we continue to see this pace of rate move continue, again, real rate driven and policy driven, it's going to be hard for EM assets to escape unscathed as a result of this shock.
In a world where we talk about central bank credibility, it feels as though Turkey's central bank's credibility is shot, and you can see that there is further weakness in the lira ahead of the policy decision. What does the central bank need to do to wrestle the narrative back and suggest that the situation is not one that's going to be worsening there, as inflation has been climbing to unbelievable levels?
Look, I mean, it's helpful to focus on some facts, right? I mean, the central bank in Turkey, between September and December cut rates by, 500 basis points. Over that period, inflation has gone from 20% to 36%. We think it's going to go up further to, beyond 40% in January. And the lira has depreciated from, versus the dollar from somewhere like 8.5 to 13.5. And as you point out, is weakening again ahead of the meeting. So in a way, the facts speak for themselves. This is a country where inflation is extremely high, very generalized. Inflation expectations are moving out of control, and policy is too easy. Policy is too easy on its own terms and has been too easy for a while, deeply negative real rates. But policy is also too easy when you think about what is happening in the rest of the world. Oil prices are moving higher, a big import for Turkey on its current account. As you were discussing earlier, core central banks, the Fed, and amongst others, are moving rates higher. In that sort of environment, cutting rates in the face of such high domestic inflation is really a pretty unsustainable policy mix, and is going to result in further currency depreciation. So there will have to be a change in the policy setting. We don't expect it to happen today. They've been pretty clear about it, but I really don't see a long-term sustainable path out of this until real rates are moved meaningfully higher.